I'm sure you want to talk a little bit about that, what you're seeing.
Well, it's great to be here. Yeah, we were heartened by yesterday's inflation data. It was the 6th month in a row of decline. I look at the last quarter of last year, and if you look there, headline inflation was about 1.8% on an annualized basis. Core inflation was about 3% on an annualized basis. Those numbers are down from double digits early in the year. And we've seen that progress on the inflation side while maintaining a resilience in the labor market that you all have been following closely, as well as a resilience on the consumer balance sheet side as well. You're looking at bank earnings. And I think one of the things that has been notable is that in this past 6 months, in addition to this progress on inflation coming down, real wages have actually turned positive. So we've now had real positive wage growth for the last 6 months. And what that's doing is it's helping to sustain the consumer and maintaining these historically low levels of credit card delinquency, mortgage delinquency. And so even as we see this uncertainty in what is an uncertain economy right now, we are continuing to see these positive signs that this transition that we've been talking about for some time to more steady and stable growth is not only possible, but looks increasingly likely. With all that said, we take nothing for granted. There's a lot of risks and uncertainties out there. And so our focus is really on how can we keep this process going from a policy perspective. Big focus on how we can keep those cost reductions going in areas like healthcare and energy.
The Federal Reserve is also still very concerned. If you listen to any of the Fed speak, any of the officials who come out and talk about this, part of it is that wage inflation that you were just talking to, that idea that wage inflation is something you really have to be very careful of. It gets more endemic and that gets harder to stamp out. There's another measure that the Journal pointed out today that in December, if you look at inflation, ex-food, energy, goods, and shelter, which is basically a proxy for all inflation that's not transitory, that inflation was up by 6.8% in December on a year-over-year basis. That's another concerning point. That's why the Fed officials are following this so closely and maybe not ready to stop hiking rates just yet. Does that sound like the right plan of action to you?
Well, look, I'll leave the actual monetary policy decisions to the Fed. I will say that as we look at the inflation picture, it is helpful to decompose it to the goods sector where we're seeing deflation, we're seeing price declines. Housing, where we're continuing to see high levels of printed inflation, but in real-time economic data, we're seeing rents coming down. We're seeing very significant reductions in real-time housing prices, the largest reductions in housing prices we've seen since the Great Recession. And then there's that category of services ex-housing. And as you noted, it's still at an elevated level. It has come down and moderated, and I think a question that we will all focus on is, do we continue to see that moderation as well? But the big question is, could we see this progress on inflation without giving up all of the economic gains that we've made? I think the data should lead everybody to be more confident that that is possible as we look into an uncertain path going forward. The one thing that I would flag on this front, though, is that the policies that we have taken and that we really worked hard in the second half of last year to put in place to provide a long-term certain investment context for investments in semiconductors, innovation, clean energy, infrastructure are really now going to take hold in 2023. So companies who are looking at their forward investment plans for the next couple of years, I hear a lot that notwithstanding the uncertainty in the first, second, third quarter of 2023, the investment environment for the United States over the next 2, 3, 5 years looks very promising, particularly if we look globally. So those are things we need to keep our eye on. But I think that there's reason in this data to see a pathway where we come through this historic transition. We don't jettison all of these economic gains that we've made, get to a more stable position of growth, and see more of that productivity-enhancing investment that we need across the economy. And, an area like semiconductors is case in point.
We try to figure out what the market's telling us versus what the Fed says it's going to do, Brian. I'm sure as an economist you're looking at that and going, I don't know. But some of the recent sort of wild cards is the reopening of China, I think. And we seem to be maybe we're making some gains on the sticky part of the inflation in the labor side, the wage side. We saw a cooler number. But what if inflation comes back when China reopens? Europe, things aren't as bad there as we thought they'd be. So you could actually see commodity inflation come back. Should the Fed see that as transitory and not worry about that as much as as what's in the service sector or the labor sector?
Well, look, there's a reason why economists and the Fed focuses on core inflation that takes out energy and food because of the volatility there.